Henley. You probably before your time, you probably don't know, don't remember. You guys are just babies with that, but yeah, that's the guy. And that's, I think that song even was from around that period. Because first he was in the Eagles, he was the Eagles. And then he went off on his own. He was doing Don Henley by himself. And I think by the time of this case, that's the phase he was in. I don't really remember that much myself. So I just wanted to put you a little bit into the period of the case. And we will talk about the case during probably most of the class. But I want to begin with just some basic material, because I think we should do this stuff first. First, though, we have now a complete TA team here. Bernardo is fresh back from Venezuela. So Zach and Bernardo are your two TAs, and well, let me just see if, first of all, is there any sort of logistics or administrative issues that anybody's getting stuck with or anything? I did now. I made it so that you can only get access to the Stellar site if you're registered for the class. So if you try to get in Stellar and you can't, there's a mechanism in Stellar that you can ask to get admission into the class, and if you're an MIT or MIT student, then you'll automatically get in there. Okay, so that's just what we have to do. And yes, we are oversubscribed at this point, but I'm sure that some of you are still shopping around, or you'll decide, this isn't a cup of tea after all. And in my past experience, I believe within a week or two, we'll be down to, you won't need to bring in the extra chairs. So, okay. What I want to start out with some basic material here from, I don't have this mic. Quicker to, Whoa. All right. So there's just some material from chapters 1 and 2 in the text that go along with this case, and including the first part of it here. So I was hoping that you guys would get interested. In real estate, let's make this noise. So we've got 2 different markets in real estate that are very important to understand. And it's important to understand the distinction, the difference between the two. And your typical, layperson out there on the street doesn't understand that there's these 2 different markets. Even some professional people who are really involved in the industry, even though they're really in these 2 separate markets all the time, they haven't really systematized it in their thinking to realize there's 2 separate markets. And once you realize this, it can really help you to understand things better. So there's the space market, which is the market for the right to use property, and there's the asset market, which is the market in which the assets are traded. And of course, these 2 markets are related to each other. In particular, the space market. So here's a diagram. This is kind of in the framework of what is called systems dynamics. This is a diagram of a system. It's a dynamical system, and then it changes over time. And you see the elements of the system and how they're related to each other. And this is a way of conceptualizing things that was actually invented at MIT, I think, largely, by Jay Forrester, a very famous person here at MIT. And Sloan has a whole little group on systems dynamics. And here's a very simple systems dynamics picture of a real estate system. And it consists of 3 major elements: the space market, the asset market, and the development industry. And the space market is the fundamental thing. That's the thing that underlies it all. If it wasn't for this, none of this would exist. The space market is, I'd say, the market for the usage and occupancy, possession of space, built space. And on the demand side are tenants, people that are wanting to use the space, and they're going to pay rent to do so. On the supply side are landlords, people who own the space, and they're going to rent it out to the tenants. And the supply and demand comes together, and they find an equilibrium in that market, which produces the rents and the occupancies that the buildings generate. That produces cash flow. And that's what the asset market cares about. The asset market is all about money. It's all about the future cash flow stream. We talked the other day that a capital asset is nothing more or less than a stream of future cash flows. So down here in the asset market, we've got supply and demand. Also, the supply is landlords. You know, these guys up here who already own the buildings, the properties, but if they're in this market, then they are at least thinking about selling, right? And the demand are other investors. So these are investors on both sides of the market down here. Investors that are in the market to buy, investors that are in the market to potentially sell. This is part of the broader capital markets where all types of capital assets are traded, not just real estate, also stocks and bonds. And so we've got these investors coming from these capital markets into the real estate asset market, and the equilibrium between the supply and the demand in this market produces a price. The price is reflected in this thing called the cap rate. At least most crudely and simply, it's reflected in the cap rate. And meanwhile, we've got, as we said, the cash flow coming down here from the space market. And you put the cash flow together with the cap rate, and that gives you the actual price of a given property asset. Because the price can be viewed as the current cash flow per year divided by the cap rate. So if you've got $100 of cash in per year and you've got a 10% cap rate, it's the pricing here, then the property's going to be worth $1,000. 100 divided by 0.1 is $1,000. This is market value, and that can be viewed as an output from the asset market in terms of information into the development industry. The development industry is basically a giant production machine that converts financial capital, that comes from the asset market here, into physical capital that goes out into the space market here. And the development industry is basically asking a fundamental question. It's the basic cost-benefit question. Is the value of these assets as determined here in the asset market greater than the cost of producing them? The cost of producing them is the construction cost and the land acquisition cost, the total development cost, including enough profit for the developer for it to make sense. If the value is equal to or greater than that cost, then yes, development is profitable and they will build. Developers build, bankers lend. That's an old cliche in the real estate industry. And so the system goes on and it adds new supply up here. The basis, so we've got some things that are exogenous to the real estate system. We already mentioned the capital markets. The real estate asset market is a branch of the capital markets. But we also have the local and national economy and the society, right, the demographics, the household formation, if you have to live somewhere, and so on. And that is basically what's determining the demand here in the space market. So these entities that are playing this game, one of the things they need to try to do is forecast the future, because the things they're building here are going to last a long time into the future. And the construction process itself is going to take a while. And so they need to forecast the future. But also the people down here, they're going to be making investments that are going to either make money or lose money by what happens in the future. So even these guys up here have to forecast the future, because a lot of these decisions up here have to do with, in commercial real estate, long-term leases. A 3-year, 5-year, 10-year lease. And you need to, if you're operating a company, you need office space, you need warehouse space, you need to be thinking about over the future, what are you going to need, when, you need to plan for that. So the whole thing should be shot with forward, people looking forward into the future. If they're really good at that, this system will work pretty well, pretty smoothly. But things have a way of happening, right? And unexpected things happen, or the system just overshoots. You can see that there's an asymmetry here. There's a sort of a negative feedback loop. Negative feedback loops in systems like this, in dynamical systems, keep the system in balance. Like a negative feedback loop is like a thermostat in a room. When the temperature goes below the set point, it triggers the heat to come on, and that gets the temperature back up. If the temperature goes above a set point, it triggers the air conditioning to come on, that gets it back down. That's an example of a negative feedback loop. A positive feedback loop would be if, when the temperature went up, it triggered the heat to go on, and it's going to get even hotter, and the whole room could catch on fire or something. Right? So positive feedback loops are explosive, and this system should normally be it should have a crucial negative feedback loop, which is, if we get too much supply here, that's going to drive down the rents and occupancy, which is going to drive down the cash flow, which is going to drive down the values here, and that's going to cause this equation here to come up with a negative, and then developers won't build, or investors won't give them the money to build, and that shuts down the development. And then, at least if demand picks up or keeps growing, eventually that'll get the system back in balance. On the other hand, it doesn't have a symmetrical thing on the downside. If demand falls here, we really take the supply away, because these are long-lived fixed assets. They're out there. So we have an asymmetrical system. So this is the big picture of the system that we're dealing with here in this case, actually in the entire class. Any questions, thoughts? Yeah.
One of the things you mentioned in the first two chapters a few times is this longevity of the stuff. 100 years, and no one really knows improvements ever. So is there a sort of, I don't know how to phrase it, like a pressure for obsolescence in the system where actually if buildings became obsolete quicker, this whole thing would function better. So even though that would be better, maybe...
Yeah, but it'll be less asymmetrical on the downside. I think basically the thing is that construction produces a physical structure that has a large, admittedly it's a sunk cost, but it has a large value. That structure enables the site to produce an income flow. And so that then has an opportunity cost if you would go to tear it down, right? But what we do see is places where land is extremely valuable. So that the value of the structure is actually a small component of the total property value. Most of the value is there in the location and the site. And we see this particularly in some Asian countries that have very high density, Japan, Hong Kong, and so forth. But almost the entire value of the real property is the land. In those places, it often makes sense, and you do see that buildings are torn down a lot quicker than in the U.S. Because after all, the building is just sort of minor afterthought, and anything is the land. So it can make sense to incur that opportunity cost of losing that structure value, because after all, it's only 10% of the whole property value. So, yeah, you're right. You can have a more balanced system in principle as a function of things like that. So, here's the space market. We talked about that. The asset market. We'll talk about that. The output here is cap rate. The cap rate is just a way of quoting prices. It is so. One way that people often think of prices in asset markets is in something called the price-earnings ratio. It's a way of normalizing the prices as a function of the incomes that the assets are generating, the current level of income. So oftentimes, even in the stock market here, people talk about the price-earnings ratio of a given stock or of the whole market, and that's the value of the stock divided by the earnings per year that the company is producing. It's the same kind of thing here in real estate, only for some reason, for whatever reason, they do the inverse of it. The cap rate is just the inverse of the price-earnings ratio. It's the earnings-price ratio, and people like to think of it in that way. I think it's more similar to in the bond market. People do quote bond prices in terms of the yields of the bonds. Well, the yields of the bonds are, what the bond is returning per period through the cash flow on the bond as a fraction of the bond value. So real estate, if you're already somewhat into the capital markets, you'll see that real estate has some elements of the bond market and it has some elements of the stock market. It's kind of in between, and of course it has a lot of elements that are unique to real estate itself. It's a bit of in some ways, a hybrid asset between stocks and bonds. And the terminology and the practices in the industry are also Some of them come from the bond market, some of them come from the stock market, some of them come originally from real estate itself. Because, of course, the type of market here in the asset market is very different, for at least the private property market, is very different in the way it functions than either the stock or bond market. We talked about that a little bit last week. This is a private search market where unique whole assets are traded. And they're traded between one buyer and one seller. They have to find each other. And we've got heterogeneous assets and heterogeneous buyers and heterogeneous sellers, and they all come together somehow through brokers and whatnot. It takes time, and it's just a very different process than we have in the securities markets. So here's a picture of the space market. Okay, so we've gone up to the top part of the system here. And what I'm showing here is on the horizontal axis is the quantity of space that's out there, the stock of space in the market. And on the vertical axis is the net rent per year, per square foot. And this is actually a depiction, however simplified, of an actual real market in the real world, in real history. And this is in chapter 1 of the book. This is at Cincinnati, downtown Cincinnati, Ohio, in the 1980s, about the same time as the case was happening. 1,000 miles away, and this is the market for Class A office space in downtown Cincinnati, Ohio. There's about 5 million square feet of space in that market, and we had a demand function of potential office tenants wanting to rent space in Class A buildings in downtown Cincinnati. These are typically 20 to 40 story skyscrapers built. You know, a few of the tallest buildings in Cincinnati were built back in the 1920s and 30s in the great Art Deco, skyscraper boom of that period. They produced these beautiful buildings, but at that time, in the 1980s, those buildings, the Carew Tower, the Central Trust, I can't even remember now, they were Class B office space by that time. We're not up to the standards that the office market demanded for Class A space. So it was newer towers that were built in the 1960s, 70s, and even the 80s, maybe a dozen or so skyscrapers that amounted to that 5 million square feet of space. And what basically happened is that the demand for office space was growing in the 1970s and 80s because of structural changes in the economy, growth in the economy, movement of headquarters companies away from expensive cities like New York into places like Cincinnati. And that moves the demand function up and to the right. So it goes from, say, a demand level like D0 to D1, and the supply responds. They build more skyscrapers, and so we have 5 million square feet and the equilibrium rent of $16 a square foot by the mid-1980s. And then what happened is developers expected and their financiers expected that the demand would keep growing, maybe to the D2 level, and they could take on another 1 million square feet in that market, build another couple, 2, 3 skyscrapers, and still keep the $16 rent. The cost of doing this, acquiring the land, building the buildings, amounted at that time to about $200 per square foot. You could sell these buildings in the market at an 8% cap rate. That was the price. Which means if you can charge a $16 square foot net rent, then at the 8% cap rate, you can sell them for the $200 a square foot, which is the cost. When I say the cost, that's the whole cost, including acquiring the land and having enough profit for the developer for it to be profitable to build. So that is what we call the replacement cost. The $200 per square foot is the replacement cost per square foot of building new supply into that market. And at the 8% cap rate, prices that investors are willing to pay, that means a $16 rent will be sufficient to trigger that expansion, and that's therefore going to be the replacement cost rent. It's the rent that if the space market is providing that level of rent or more, then the development industry will add space to the market. Now, what happens? So they built a couple, 2, 3 more skyscrapers at the end of the 80s. But unfortunately, things didn't turn out the way they were wanting, and what actually happened is the demand didn't grow. And furthermore, actually the demand shrank. because there was a recession. And so now we're up here with this level of supply. And notice the kink in the supply curve. The supply curve basically has already the amount of space that's out there, and we can't reduce that. Not very easily, not very quickly. So when demand grows, we can build more space pretty quickly and pretty easily. Not right away, but pretty quickly. But if demand shrinks, we can't reduce the supply, so we're stuck on this vertical inelastic supply function. So if demand grows, we won't, in the long run, get an increase in rent, not beyond the replacement cost level of rent, the equilibrium rent. But if demand shrinks, we will get a rent below that. And we have this asymmetry in the system we talked about already before. So what actually happened in Cincinnati in the late 1980s, beginning of the 1990s, and this was typical. One reason people sort of pick on Cincinnati is it's kind of the average market in the U.S. It's like, Mr. Average City. And so this happened in a lot of places, almost everywhere. They built too much supply, particularly office buildings, and demand stopped growing and indeed shrank, and so rents plummeted. Temporarily, rents probably fell down to the equilibrium point here, where the D0 demand crosses the expanded supply, which is about $10 a square foot of net rent. Now, eventually, the story picks up. By the late 1990s, we were beat out to a level like where the D2 is, and back to the sort of long-run equilibrium rents in Cincinnati and in most markets in the country. So, real quick nutshell, this is the kind of thing we're dealing with, and it fits into the Walden case because some of this terminology. In the Walden case, you read about how the cap rate in the market at that time out there in suburban Boston was 9%, and they wanted an additional premium to make it worthwhile for a developer to take the risk and require the profit for the development phase itself. That's part of the aspect of the case that we will talk about a little bit more in a few minutes. But let me pause and see if there's any questions here. Yeah.
What can we find the cap rate?
So that's a great thing. There's a lot of information now in the market out there, and a lot more than there was back in the 1980s. But even in the 1980s, people who were in the business, in the real estate industry, they knew what cap rates were. Because it's like, it's the prices that the products are trading at that are your products. So you know the prices. But now there are firms that gather this information and publicize it. And you have to typically subscribe, pay for the information. But there's a lot of information coming from two major types of sources. Either actual transactions, so you can see the actual cap rates that are prevailing in the transactions based on the transaction prices. Surveys where people survey brokers, they survey investors, and they say, what do you think the cap rates are? What are typical cap rates in your market? There's two major types of information. So, and this is actually, a lot of this is in the book, like chapter 1, goes into chapter 1. Okay, so, yeah. Because supply response, competition between landlords, competition between new skyscrapers that get built here to get tenants to come and occupy the space to keep the rent down. Now, rents may temporarily spike up because supply can't always respond right away. Some tenants really need their space right away, but for the long run, well, this is a long run thing.
That's a stupid question. Why only have the private market, but there is no public market?
Well, there is public market real estate investment trusts that are traded in the stock market, but it's kind of a second level, right? This is what's going on at this fundamental market underneath where the physical assets are directly traded. Now, many of these assets, not so much in the 1980s, but by now, many of these assets would be owned by, some of them would be developed by REITs that are publicly traded companies. And that's another dimension. You kind of have two parallel markets asset markets that are trading the same assets directly or indirectly, the private property market and the public securities market, which makes for some interesting situations, including possibilities sometimes of some arbitrage between the two markets. But this is all a subject really for the next semester's course, not for this one. Here we're really at the fundamentals, really focusing on the private property market. So if you're mostly only interested in the public securities markets aspects of real estate, it's really next semester that we have the courses for you. It's we have 2 courses, real estate capital markets, and also this course that's specialized on mortgage-backed securities. So okay. So one thing that's important when we talk about markets is there's a thing called the law of one price, famous aspect of markets. The law of one price says that the same thing can't trade at 2 different prices at the same time. Okay, if it is, imagine that, I don't know, ice cream cones. You can get them for $1 here and $1.50 there. Where are you going to get in the same ice cream cone? Okay, and you can easily go either there or there. Where are you going to go? You get the ones for the $1, right? On the other hand, if you're selling ice cream cones, and you can sell them for $1 there or $1.50 there, where are you going to sell the ice cream cones? Right? So, if indeed that's where it's one market, right? In one market, you can't have 2 different prices for the same thing at the same time. But suppose there's a wall between those 2 ice cream stands, and if you're on one side or the other, you can't go between. You can't go from one to the other. Then it's 2 separate markets, and they can each have their own separate prices depending on how many people want ice cream on the one side versus on the other side, and how many people want to sell ice cream on the one side versus the other side, right? So that's what we call segmented markets. And real estate space markets are segmented because they are location specific and they're physical product type specific. If you need an office building, a retail shop won't work for you. If you need a building in downtown Boston, then downtown New York won't work for you. In fact, suburban Boston probably won't work for you, right? So, and buildings can't move. They can't, in most languages, or I don't know, in several languages, European languages anyway, the word for real estate is literally unmovable. Immobilier or meuble or whatever. See, meuble is French for furniture, which is movable. Anyway, so this causes the markets to be segmented. We've got as many space markets as we have property types and locations, and they can have different prices, very different prices at the same time, meaning the rents are different. Okay, here's a visual example of it. This is from 1988 to 2010. The rent per square foot per year for a bunch of different sub-markets of the Manhattan office market. So even this is just within one borough of one city. Now, it's a big one. But look at the range in rents. And now you do notice they all kind of move together. They have to have a certain relationship cross-sectionally between each other. The most, the high-classiest places, Rockefeller Center and what would it be? Columbus Circle, maybe. These are the classiest locations. And at the bottom, we kind of have Penn Station, maybe Battery Park for office. But so Battery Park was kind of pretty decent in the 80s, but by 2010, it was not. And maybe they'll turn around with the World Trade Center coming up. But anyway, there is a cross-sectional relationship that tends to be keeping the same ratio, but quite a divergence in the absolute prices that are charged for essentially the same physical product, right? Just the location is different. But we could also, I could show you the difference in rent between, say, retail and office at the same location in Manhattan. The ground floor retail space may be $100 a square foot. Right above it, you might have office space that's $50 a square foot, something like that. So that's what we mean by segmentation in the space market. Got some specific examples, but I'm going to fly through some of this. Sorry, I'm going to go quickly through this stuff. I think I'm going to go back here a minute. This point about the supply function and the long-run marginal cost. So, in a market, in a competitive market, the supply is the amount of space that the amount of product that the market will supply as a function of the price that they can sell it for. In the real estate market, the price that they can sell it for is the rent divided by the cap rate, and the cost is the development cost. That's what adds new product into the market. And if we go back to our picture here, this is the supply function we're talking about. And this function, I've drawn it to be clearly it's practically vertical at the current supply, right? But if you add supply, I've drawn it to be flat, to be like infinitely elastic, meaning that the next development is going to cost the same thing as the previous development, in real terms anyway, after you take out inflation that might have happened between. And so that would be an infinitely elastic or flat long-run marginal cost curve, meaning the cost of development in real terms is the same as we add more and more space into the market. It's not necessarily going to be like that, right? It could be that as you add more space into the market, it's going to get more expensive to build additional space. Or it could be that as you add more space in the market, it actually gets less expensive. So what could cause it to get more expensive? What could cause the next development to be more costly in real terms than the previous development? Yeah.
You're competing over contractors. There's only a finite number of steel contractors.
Could be, but in reality, usually there's a lot of elasticity of supply of construction.
Well, most attractive sites are taken.
It's more having to do with the land, right? Land is the thing that's more inelastically supplied. There's only a fixed amount of land, and if you have growing demand for a location, and there's only so much land in that location, that's going to bid up the price of the land. So that can cause it to be more expensive over time. And also, another way that it happens is it gets all built up, right? So then, in order to build the next building, you have to tear down a previous building. It's like what we were talking about earlier with Matt's question. So you have the opportunity cost of that existing building that you're trying to suffer, getting rid of that existing building. So that can cause the cost of development to rise over time. What about what could cause it to fall? Then I'll give you a hint. The cost of development actually has fallen over time in real terms in the centers of most American cities. On the other hand, don't think it's fallen over time in Hong Kong or Tokyo. So, Charles, you were going to...
There's lower demand for new things.
Okay, we could have a Detroit, where there's literally lower demand. But actually, even in American cities where there is growing demand, even in New York, this is 1992. New York, $33 a square foot. This is 2000. New York, $38 a square foot. Both of these actually were bottom points in the rent cycle. 1992 was a low point in rents. 2010 was a low point in rents. So we're comparing apples to apples in terms of the cycle. $38, say, okay, well, rents were higher in 2010 than they were in 1992, but what about inflation? Take the purchasing power out, and this is actually a drop from 33 to less than $25 in New York, in Manhattan. So that's clearly a city where demand has definitely grown from 1992 to 2010, and yet still the rents have fallen. So how can that happen?
I have two ideas. The first one is like a lot of industry move to other countries like China, or their headquarters move to another country.
Yeah, but this is office, and this, I'm telling you, the demand has grown. So it's not that. Okay.
people have probably started using telecommuting. Like
Exactly.
nowadays.
Exactly. The value of centrality of location has declined because of technology. How many of you have a cell phone? Anyway, so you can get a reduction in land value because land value is fundamentally the value of the location. And that has all to do with the value of centrality or accessibility of a point. And so we'll be talking more about that. So anyway, what we're focusing on right now, particularly in this case, is the development industry, part of the system. And just a little bit of introduction to the development industry. This is a picture of how cyclical is development. It's the most cyclical part of the real estate industry because, like we say, the buildings are long-lived, and you only really need to add new buildings when the total demand is incrementing above its previous peak. So we actually just crossed an interesting threshold in the U.S. economy this past summer. Finally, this past summer, there's more total jobs in the U.S. economy than there was at the previous peak in 2007. This is the longest time it's ever taken after a recession to get back to the previous level of employment, for 7 years. Other than, I think, the 1930s, the Great Depression. Right? And that's a crucial milestone in the real estate industry because that means all of a sudden, now finally, there is need for more total space than was already out there in 2007. So only now is there starting to be major pressure to build new space. Now, a big exception to that was apartments, multifamily. Okay, that's a separate kind of market, right? But the types of real estate that depend on total employment, especially office buildings, they're only now, on average, coming to the point where they really need new development. So you only need new development when the economy is expanding beyond a previous peak. And as a result, development is very cyclical. Also notice here, kind of like the world's lowest ever redevelopment or development rate at the end of the previous crash and the bottom of the recession. Just after the gray bands are the periods of recession. So you see that the development industry is kind of clearly affected by those recessions, but in a kind of a lagged way because of the time it takes. And this level of development is below the replacement cost, or the replacement rate. And Matt's point that buildings do wear out and they do eventually get replaced, maybe faster in Hong Kong and Tokyo than in the U.S., but they do even in the U.S. And this rate of development, less than 50 million square feet per year, is not enough to replace the buildings that are just wearing out and getting demolished or closed down. So that implies an actual reduction in the absolute amount of space that's out there. Hardly ever previously in this 50-year period do you see that level, that rate. Okay, some of this I think are points that I've already just talked about. I guess I should have gone to this slide to make a point about the rising and the falling supply function. And the point about even in Boston or New York can happen. Here is somewhat relevant for our case. From kind of just before the decision point in our case, which is 1993, through the recent recession, the average rents in suburban Boston office market, in the CBD, and in Cambridge. And you see, how would you characterize that picture? What are the major things that jump out? Then we talked about the segmentation. So you see different rent levels in these different locations. And what else kind of jumps out longitudinally?
In real terms, the rents have bigger.
Right. This is adjusted for inflation. So yeah, we don't have a long run positive real trend. And what else jumps out longitudinally? cyclical, pretty cyclical market. And by the way, the cycle is not necessarily the same as the asset market cycle. So, where's the picture here? We've got a cycle here in the space market, which has a peak in the late 80s. Okay, we also had a peak in the asset market in the late 80s. But we've got a peak in the late 90s, and then a crash in the early 2000s. We did not have that over here in the asset market. Well, here's an even better picture of it. This is like the top 7 markets combined together, and the gray line is rents adjusted for their trend, and in real terms, and the black line is asset values. So they both can be cyclical. The cycle is sometimes the same. It was the same in the 80s. So both the rents and the asset values peak at the same time and crash at the same time. But sometimes they're different. At the end of the 90s, there was a peak and a crash in the space market, in the rent cycle, but not in the asset market. It had its peak and crash a little bit later. Karthik first.
Shouldn't the increasing rent would have kicked off the asset market, like probably where the peak was?
It started, you mean in terms of the asset market, you mean the development industry?
Yeah.
In terms of creating new supply. It started to, but what you had in between is the development of the public securities markets in real estate, and a lot of the financial capital by this time was flowing through CMBS and REITs. The public markets, nothing else, are very quick at responding to news. And what happened in 1998? The Asian crisis, right? That so-called Asian flu, and it spooked the public markets. Not just spooked them, it's a real threat, right? And the public markets all of a sudden crashed, and for real estate, and basically they cut off the flow of financial capital, which was going to perhaps start a building boom, but hadn't really done it much yet. So there was that in favor in terms of physical supply in the space market was relatively strong, or relatively favorable conditions. And also you had, when the dot-com bubble burst in the stock market, investors in the stock market sold their stocks, and they had to do something with the money, what little they had left, and they wanted to put it in real estate, among other things, because real estate was seen as kind of the opposite of the dot-coms. It's a real physical, tangible asset that's producing real cash flow. And so that actually kept the asset prices pretty strong, even through that recession, that there was a recession there. So unfortunately, then it went into overdrive. But so I guess my point here is that while we do have this negative feedback loop that can keep the system in balance, we also can have positive feedback loops either in the space market and development industry, which is what happened in the 1980s, when you had basically this money getting thrown at the real estate industry to build new supply, because rents were rising, and capital prices were rising, asset prices were rising, and it created a bubble or a positive feedback loop, which crashed at the end of the 80s, early 90s. You read something about that in the case. The bubble that we had here was not at all for commercial real estate, as contrasted to single-family houses in the U.S. The commercial real estate, the bubble we had more recently in the mid-2000s was purely in the asset market here, in the capital markets. It was not in the space market, the development industry. We did not have overbuilding as we went into the crash and the recession here, and that has helped commercial real estate to be able to bounce back pretty quickly. So I've covered a lot of ground here, and I want to switch to the case. But one quick last question from Paul.
Can we go back one slide to the Cambridge suburban Boston? Yeah. And I'm correct in reading this and seeing that the suburban office is less volatile over time. Is that because it's more able to respond to plans as land constrained?
I believe so. I think that's a very good, very astute. Everybody get that? When you can more easily build more supply, that's going to tend to keep rents from running up. And if they don't run up too much, they're not going down, and they fall down too much. And it's more easy to build new supply in the suburbs of Boston than it is in either Cambridge or Central Boston. So, okay. So we're going to talk about the case. Oh, before we do that, I have a little thing here. Sorry. This is very hokey. Bear with me. I have to do this. I don't know why. So I happen to live very near Walden Woods. Doesn't really show me much, does it? So yesterday, me and my wife and our dog, we went over there to Brister's Hill, which is a very nice little park now. Well, it's not an office building. And here. So, Sunday, September 7th, we're in the heart of Brister's Hill here in Compton, Massachusetts. This is my dog, Mike. And at the heart of the sort of memorial here is a circle of granite stones. And on the tops of these granite stones are written quotes from famous people. For example, the one right here is actually Henry David Thoreau quote. And I have to explain. My dog here is not so much my dog, she's my wife's dog. My wife is taking the pictures. The dog is like totally focused on my wife. The dog is always totally focused on my wife because he's a very loyal dog. But anyway, I have to do that. The other side of it, so you can sort of see what it looks like. It's not a great forest. It's just, little sort of second growth birch trees and whatnot, but this is what Thoreau discovered, that you have these regeneration types, pitch pines, birch. Here we have a quote from Chief Ether Standing here. The old Lakota was wise. He knew that man's heart, away from nature, becomes hard. He knew that lack of respect for growing living things soon led to lack of respect for humans too. So there's quotes like this all around. And this is Brister's Hill. It has been saved from the development. All right, so you see a little bit there that indeed the forest is not a forest at all. And this is, 30 years after they saved it. It hasn't been growing much either. But in fact, it actually is part of the point that I guess the idea was that Thoreau roamed around, because even back in the 19th century, that area was apparently, it had suffered fire, and I think there was even a quarry there where they got sand and stuff. So they'd already messed up the forest when Thoreau was living there in the 1840s. But he wandered around there and he saw how the forest regenerated. And he developed the idea of succession, that there were certain species that would come up first, and then the shelter that they would provide, different species would come up and so forth. And the pioneer species was this white birch here like this, and the pitch pine. And those are still there. But something that's blocked the succession of this forest. But anyway, it is kind of educational and nice. And what we want to do is, first of all, just give us a quick timeline of the case, what happened when. And what I usually do for cases and for the homeworks is cold call people, because that's what they do at Harvard Business School. And this guys can take it from you guys can. And so I have a random student generator. If I press if I press F9, it will generate a random. Oh, no. It's doing that. So it's not letting. Does anybody know why it's doing that? Maybe I'll close it and reopen it. Oh, okay, good point. Thank you. Yeah, it's very confusing on the laptop. Okay. Function F9. Okay, here we go. Jeffrey So.
Sorry.
Okay. So, would you like to? The thing about cold calling here, unlike Harvard Business School, you do get to pass. If you don't want to do it, you can pass. And we actually have the second, the near miss. But it's for you, Jeffrey. Jeffrey's good for it. All right. So, and you don't have to go through the whole thing, but we'll start with you. If you could tell us, and I will record here, and we're going to record this for posterity in class. Jeffrey says. So we want to do a timeline here of the significant events in this story, this history. Where do you want to start us?
Do you mean the case question one, or?
No, I mean what happened in the case. You know, the history or the story that really happened. Just we want to sort of refresh the mind.
So basically, Boston Properties, they had an investment in Concord, which is pretty much the suburb area around Boston. And in the trend of these urban area people flocking to the suburb area for residence and for better life.
So this is period of time what?
During the mid 90s, I guess. Around.
Actually, no. Let's go back. This is actually even it started.
It's the investment during the mid 90s. The trend.
Suburban office development around Boston, right?
Yeah.
But actually, I'm going to take you back one step further, 150 years earlier.
It is the site for the first battle of the American Revolution War.
I like that, but I didn't mean quite that far. Because actually, the site is not too far from there, but far enough that wasn't an issue. The issue was, the road.
The right
out there, right? Let's be real nice with that. We've grown down. Okay, so that's, in some sense, that's the first crucial thing in this story. But then, yes, you have the suburban office, and actually Boston Properties. BXP is the ticker for Boston Properties.
And later on, when Boston Property has purchased that piece of land, the wood around there got vegetated. So
sorry, you got one other thing here. What happened in 1980? Remember? Before Boston Property bought them. Rezoned it, right? And the case actually says that before then it was never economically profitable to develop the site. The case says that. And indeed, it hadn't been developed, and there's no reason why it couldn't have been developed, so I guess it's true. Okay, so there's an evolution going on here for that site. An evolution related to supply and demand and the kind of urban markets that we're talking about here. Okay, then go ahead.
Then when the Boston Property wanted to develop the site, the environmentalists as well as the socialists come in and this
Socialists?
Kind of-
We don't have socialists in this country.
The socialists, the people who are concerned with the cultural background around there, come in and have like a top.
Okay, but you're leaping ahead faster than I want to go. I want to get the specifics in here. So in 1984, they bought the land.
Yes, okay, we bought that.
For how much?
For 9.2
People want to know.
Sorry.
So, okay. So, Jeffrey, thank you very much. We're going to generate another random student. Or should we go to the second? We'll go to the second one here. Charles. You can pass. Oh, sure.
In the 1800s, the site was used as a quarry for sand and gravel.
Okay.
Zone
Wait a minute. I have to move all this stuff. Ah. Okay. P.S. Quarry. Okay, we're moving to Charles here. Say, I'm not sure if that's how you spell that. But anyway, okay.
1965 was zoned for the first time,
Okay.
and then that contract.
Well, what does that mean? How significant is it zoned for the first time? What does that mean? Before that, apparently, it didn't have a zone.
We don't have experience with the information before 1965, but everywhere I've lived,
You've always lived, apparently, you've never lived like out there, really out there. So it must have been really out there before 1965. It must have really been like in the agricultural hinterlands beyond suburban Boston. Right. Anybody know when Route 128, the inner beltway, was built? Transportation people here? In the, I think the late 50s and early 60s. Or after 1956. So, and so when 128 was built, what we now call the inner beltway, that it was built at the outer edge of the suburban built-up area of Boston. So it wasn't until the mid-60s that was even considered sort of the suburbs of Boston. So a huge thing that's going on here is the expansion, the physical, the aerial expansion of the Boston metropolitan area. The expansion of the boundary, the effective boundary of the Boston metro area. So that places that had been outside of the urban area completely are now inside of it. And that's a very dynamic kind of environment. It means that the highest and best use of what sites can be put to is changing dynamically. So before 1965, it would have been agriculture, except that the soil was lousy on that particular site, so it was really nothing. And then beyond 1965, at least the zoning board was thinking, or the planning commission that makes the zones, was thinking that, hey, maybe what with the Beltway now completed, the inner Beltway, and with Route 2 crossing nearby there, maybe get some commercial development there. So, put that there. I don't know. I think it was kind of a stupid zone. There was a high school right near there. I don't think you would particularly do that kind of restaurant and motel next to a high school. It's not nothing wrong with that, suppose. But anyway, they didn't build any restaurant and hotel there. Right? So go ahead, Charles.
So 1986, Boston Properties spent a year meeting with all the regulatory agencies, getting their permits in law. And they got their first approvals in 1987.
Okay. Oops. Oh, geez. You know what I mean. So let's pause and what do you think about that? They bought the land in 1984. First approvals in 1987. Have the conservationists, socialist or not, have they made any problems up to this point? No. So even without any problems from the conservationists, even with everything going in the way that Boston Properties would have had to have expected, it's 3 years, and they're just getting the first approvals. John.
Well, for the first 2 years, they didn't even do. Sorry. For the first 2 years, they really didn't do anything, right? They just started their meetings in '86, and in '87 they got the first approval. So a year really isn't that bad for the process, right?
Okay, but well, I have to think they must have been doing something in 1985, probably figuring out what they thought they wanted to do with the site, even some conceptualization and some basic feasibility studies, and then getting the process going with the agencies, which takes a lot of, you have to do some background stuff before you can even start those meetings in 1986. Imagine they were doing something, maybe also lining up with potential financing sources. I don't know. Hopefully they were doing something. But the point is that it's 3 years already, and we have to assume it's kind of going according to expectations. What does that tell you? Does that raise any issues in terms of the economics of the thing? They bought the thing, paid for the land in 1984. So a number of you have been developers, or you've worked for developers. Is this typical, or if not, what's a more typical timeline?
Usually, I know office building office development of 3 years ago.
Yeah, so everybody heard Connie? Yeah, usually you don't, a developer won't typically buy land and not get anything going, even in the ground for 3 years. Unless, they don't. They're either going to have another way of dealing with the land acquisition, such as an option or a joint venture with the landowner, so that they don't have to actually put their money up, much of it, until it's pretty much clear to go forth with the project. It's more typical the way developers would do it. Alternatively, a developer might do it this way if they're not just a developer, but they're also a bit of a land bank, meaning they buy land just to hold the land, have that land so that they can strike it whenever they want to. They can do it whenever they want to. In that case, they're actually a little bit, in addition to being a developer, they are a bit of a land speculator, which is another type of real estate investment activity. It's a type of real estate investment activity that's very risky, very volatile. You've got to be really good. You really got to know the real estate, your market, your locations, to be a successful land speculator. Now, Boston Properties has already at this time a long history and a successful history in Boston real estate. And Ed Lindy, who is, by the way, an MIT alum and civil engineering department, and Ed Lindy sort of cut his teeth working for Spalding and Sly originally in the 1950s, I think. And Hank Spalding, this is a little aside, Hank Spalding, founder of Spalding and Sly, which is presently Jones Line LaSalle in Boston. Hank Spalding was the founder of the MIT Center for Real Estate, okay, where you are now. So Hank Spalding was also an MIT alum. Anyway, the case was written by Harvard, but it's really about MIT. We know that the MIT people are very smart, and Ed Lindy was very smart, and they bought this land, and they didn't seem particularly rushed about getting a shovel into the ground. And/or they must have probably known that it was going to take quite a while to get the shovel into the ground. You combine that with just the basic numbers that are there, and it does make you wonder a little bit. And we will delve into this in a lot more depth, not just today, not primarily today, but as we do some more homework assignments on this case. Let me go to one third and last random student. Let's see if my thing will work yet. Ming, shoot, Ming. All right. So, can you take us beyond your Charles?
In 1987, there's another guy who wants to develop residential properties in the same area.
Right.
Yeah.
And what's happening with him in 1987?
And he
Right. He's having to deal with what we call pushback
yeah.
from the NIMBYs. Right. Not in my backyard. We love to have affordable housing, just not if it's near my house. And including somebody is raising cows, and they're complaining that if you build this many, affordable houses, my cows are not going to have clean water. I mean, it's really pretty bad. But well, that's the first inkling that maybe there's going to be some political trouble here in Concord. And okay, more things started to happen in 19. Well, is there more stuff happening here?
And in 1987, there's also some conservationists.
Right.
Yeah.
There's the there's the what they formed the DCCA, right? The Thoreau something or other, and also the historic commission, right? Or historic. So you begin to get this pushback, and 1988.
And the Walden country was asked to provide the EIR.
Right, they have to do now because of this political opposition. Environmental impact report is required. What else happened in 1988? Where's our approval process?
The zoning board was approved some of these.
Yeah. In June of '88, right. So, apart from this political pushback that caused the state to step in and kind of override the local processes by requiring environmental impact report, they could have begun to build in 1988, right? Is that right? Mm-hmm. Yeah.
I would also add some macroeconomic context.
Right. 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 Very good point. So they could have built in 1988, except for actually two things. One is they got blocked in the political front, this caused by the requirement for the environmental statement. But secondly, the economy started to remove the economic justification for the project and the financial facility.
That's another way. It's more influence on the developers. Or how do you zone it like there? Or you think the zone is the office space, and then you put the box and everyone buys building. I always thought the developers would influence the zone, but then there would be change.
Developers influence zoning? Have a good time. Zoning is a, province of the local governments, and local governments are very susceptible to influence by development. On the other hand, they're also susceptible to, the local electorate sympathies or sentiments. In the case of a town like Concord, you can see how the developers can be overwhelmed by the local. Well, I wouldn't say they're not overwhelmed, but they kind of certainly do. Yeah, I mean, we have a lot of urban planning students here, right? And in principle, zoning should be kind of a political and technocratic process that comes up with the right land use for each part of the city. In reality, it's going to go through a political process in the real world, and there's going to be a lot of influence from developers, but that's also not all that, right? Because developers do have a tremendous amount of expertise, and they're the ones that ultimately are going to have to, if there's anything going to be built, it's going to be built. So, it's a possible political process. All right, about 10 minutes. I guess let's just keep going. Let's go to 1989, men.
There is some writer coming, they noticed this image and he decided to approve project in the Walden area.
Right, so he decided to really let's get some real publicity. There's already a lot of publicity that's going on. Probably started with the local Boston papers, and then it spread, became a national story. CNN ran the story in all 89. That's how many out in California heard about it. And he got upset and he decided to really help this cause, to raise a lot of money and to organize and get more publicity and move it to the and so it became more and more difficult politically for Boston properties to proceed. However, they actually did have, by then, what else happened in 1989? With the environmental impact report approved, right? So actually, they don't have any more roadblocks in terms of legal roadblocks. They could build by now. But we're now up against this uproar, this international uproar by doing it. Plus, the economy is going to be worse. The economy didn't start to, we weren't really in a recession yet, but the real estate, commercial real estate industry is definitely in a bad trouble. There's a thing called the savings and loan crisis, in which hundreds of thousands of savings and loans, like banking institutions in the U.S., went bankrupt. Federal government had to step in and bail them out. They went bankrupt partly because they had issued so many commercial mortgages. The real estate was gotten overbuilt all around the country. And the result was a real credit freeze. It's called the credit crunch. And it was particularly targeted on real estate credit. So it became, already by 1989, very difficult to get financing for real estate development projects, not only in Washington, but all around the country. And sure enough, fairly soon after that, the country does go into a recession in 1990, actually triggered by probably the invasion of Kuwait, but not helped by the situation that was prevailing in the credit market. So there was no way that Boston Properties could economically build a project. So all this, uproar that John Henry is generating is probably not actually having much effect on the ground yet, because it wouldn't have happened anyway. But what else? Any other significant things that we need to? I'll do that. maybe all the way to okay, they spend money on a lot of stuff, right? First of all, a lot of the permitting and just getting the project ready to go, all the design work, legal work. But there's another element of cost which you can think about, and that's they spent 3.1 million in 4. That's money that could have otherwise been doing what? Earning, so there's that capital carry cost. Now that capital carry cost, what is the nature and meaning of that? Let's say, I don't know, if you, I think I actually have this somewhere in this. If we just figured a opportunity cost of 10%, that's not the rate, that's not a rate, then by 1993 they've got capital investment of 7.2 million. What's the meaning of that? Can you give it opportunity cost? Opportunity cost is what you can get today. Today. This is really, I would argue this is a sunk cost. This is not really relevant. I know that Lindy and Zuckerman certainly thought of this as a real cost. They thought they should get reimbursed. I can see emotionally how they would think that. I can also see from a business perspective how they would argue that in negotiating position to negotiate to try to get as high a price as they can from the environmentalists. You really do have this cost and everyone gets reimbursed. But it's cost. Nobody will pay them more than $3 million for the land. The opportunity cost of the land is $3 million, even today still. Even in 1993. Right? I think that the only other future point that we need to add into the timeline, and we'll kind of stop today with just satisfying ourselves with filling out the timeline. I'm sorry? Yeah, he bailed. Yeah. Normally, that's never a good sign when the other guy bails out, but and he sold at a loss. But I think the point here, if we go all the way to the decision time of the case, 1993, is that economy and real estate markets turning around. So this is what kind of makes it not a trivial decision, because, like I say, Lindy was smart and really knew real estate, and he knew that by 1993 he'd weathered through the bottom. He he spent $3.1 million in 1984, and then some other costs since then, and so far he's got nothing to show for it. But right now, he's in a very good location, and the markets are turning around. So facing that, maybe this is all of a sudden now more value. And let's really have to stop. So that's okay. We'll pick up with some more questions for you to think about for Wednesday about the case, and maybe a little more reading to do on the textbook. And then we'll continue